Jason, let's begin with Goldman. What were your key takeaways after you listened to the conference call in particular?
Yeah, we thought it was a sound quarter. Obviously, the stock had a big run up into the quarter, so you're seeing some selling today. But I think the biggest takeaways were how this company is basically kind of redesigning itself, kind of looking across its businesses, kind of reimagining itself going forward under a new leadership team, and really looking to expand both the customers it serves as well as the products it services them with.
Obviously, you think it's doing a successful job, but if you look out a little bit more medium term, are there any risks to any of those businesses that it's incorporating or maximizing?
No, I think the biggest risk near term is obviously the outstanding saga around 1MDB. Ultimately what that costs them in terms of a fine or whatnot, remains unclear. And then, the businesses are somewhat subject to the whim of the markets, which we've seen volatility kind of come in a lot over the last several months. So I'll be curious to see where that goes looking out.
Return on tangible equity, about 11.7% right now. Is that enough? Will that continue to satisfy investors?
Over time, we think there's an ability for them to do higher than that. We think one of the reasons they're actually, kind of reconceptualizing the company, and I think at some point, beginning of next year, they'll come out with some sort of ROTC target or ROE target, for the longer term, and we think it'll be something, north of that once they find ways to better, utilize their funding base and capital base, and just expand the revenue opportunities really across all their major business lines.
Is the street giving David Solomon a pass? Obviously, the investment banking side of things did quite well. The trading side of things didn't. And yes, you can talk about tough comps and so on, but shouldn't Goldman do better?
I think Q1 was a challenging quarter. Obviously a lot of things going on, but you did have, to your point, a very good one, Q18, kind of coming off tax reform. This quarter, obviously didn't have a repeat of that. Plus, you had volatility drop significantly after elevated levels from Q4. But I think, to the point earlier, I think looking out, there's a lot of opportunities for the firm to do better. We think they're taking actions to kind of re-look at the FICC franchise, make some changes around commodities, make some changes around FX that should garner, improved profitability results, over time.
Citigroup's FICC was a little bit of a surprise too. What's causing the stock at Citigroup to turn lower now? Just a little selling?
Yeah, if you look at the banks as a whole, they've outperformed the market 10 of the last 13 sessions, including a big pop on Friday. So you're giving some of that back. Shares of Citi are up 30% year to date. But, we think the quarter was sound. They did, surprise on the FICC side. They did post their 10th straight quarter of positive operating leverage. And, we think that set themselves up, for another kind of meaningful capital return story in 2019.
Are the big banks gearing themselves up to be major players in different areas so that they'll sort of avoid each other's territory, Jason? Is that what's going on here?
No, I think the group as a whole, has put up, decent results. I mean, if you kind of think about, you've had okay investment banking results, but the outlook there is pretty good. You're seeing M&A remain active. You're seeing, backlogs for IPO underwriting particularly strong. 2Q, Q3, as a lot of deals didn't get done in Q1. You're seeing pretty much positive operating leverage, benign credit quality, loan growth. The only kind of negative is you're seeing some uptick in kind of commercial non-performing assets, and you've seen kind of net interest margins after expanding for 3 years starting to level off. But still, against that, we still think net interest income can grow this year.
What does it all say for Morgan Stanley later on in the week?
Yeah, no, I think generally speaking, what you'll see out of Morgan Stanley is not, inconceivable. We've seen some others. So you'll see, trading revenue is likely down on a year-over-year basis, but for the first time in 8 quarters, you'll see FICC outperforming equities. And in the investment banking front, you probably get fees declining linked quarter, but you could see an increase in debt underwriting revenues, but that gets offset by lower equity underwriting and M&A fees. I think importantly, looking out, though, they'll talk to a very constructive outlook for both IPOs and advisory.
In your universe right now, Jason, what would be your top picks?
Yeah, I would say among the biggest banks, JP Morgan is our top pick, followed by Citigroup.